Hello traders! In this video, we'll look at supply and demand trading strategy and how we can benefit from it. The supply and demand trading strategy is a type of price action trading strategy, similar to horizontal support and resistance. It comes from supply and demand dynamics that we can find in the financial markets and anywhere in the world. For example, Apple released a new iPhone, but this time it would be a special edition with limited devices to sell. There will be a lot of buyers or demand who will drive prices higher. On the other hand, if Apple released a new iPhone with unlimited pieces to sell and it would get bad reviews, there will be enormous supply to sell but no demand to buy. Because of that, they will have to drive prices lower until they find buyers willing to buy. This is the same in the financial markets where prices rise once aggressive buyers overcome the sellers. In other words, demand overcomes supply. Or vice versa, when aggressive sellers overcome buyers or supply overcome demand. One of the common misconceptions many traders assume is that when markets move quickly in one direction, it is because there are more buyers than sellers. This is not true, since for every buyer there has to be a seller and vice versa. When the price goes up or down, there is no supremacy on either side, but the amount of aggressivity or willingness to buy or sell for higher or lower prices. If we look at this idea from a more advanced perspective, traders can place two types of orders in the market: limit orders and market orders. Let's say you have an instrument that is priced at $100 and there are limit orders above and below prices. At 101, you have 5 limits orders to sell. At 102, you have 10 orders to sell. Below the price, there is 5 to buy at 99 and 10 to buy at 98. For the market to move higher, there has to be someone who will buy 5 contracts to move to 101 and 15 contracts to move to the price to 102. If aggressive buyers want to move price higher, the limit sellers above the price start to pull their orders from the order book, and the price will just keep climbing higher. When there is an obvious aggressivity from either side, supply and demand zones are created. If you want to understand why these zones give us trading opportunities, we have to think about who moves the markets. We, as retail traders, do not move the markets. The institution, banks, and large funds do move the markets. Compared to us, these market participants cannot just execute their orders wherever they want. They need enough liquidity in the order books not to get significant slippage. That is why they use areas of consolidation for entering the market. More often than not, they cannot execute all orders at once. So when prices drive away from the consolidation zone, they still have unfilled orders inside. That is why markets often react once zones are revisited. How to identify supply and demand zones? If you want to identify supply and demand zones, you have to look at consolidation before the large expansions. The demand zones are found in consolidation before a large move up. The supply zones are found in consolidation before a large move down. The larger and more aggressive the move, the more significant supply or demand zone is. What makes a good supply and demand zone? Besides a large move from the zone, we look for a few other factors that give us confluence for traders. Zones on higher time frames will always carry more value than those on the lower time frames. The time market spent outside of the zone is also necessary. You don't want to see the market being crazy all over the place, going back and forth. What you prefer to see is a nice rounded retest into the zone. How to trade supply and demand zones? There are 2 ways to trade supply and demand zones. First one is a set and forget approach, when you simply put limit orders at the top of demand zone or bottom of the supply zone. This gives you more freedom from looking at charts, but of course, you might get quickly taken out when the price just spikes through the zone. The second approach is to wait for the initial reaction and enter with a market order. Your stop loss should always go to the other side of the zone, and you can target the next supply or demand zone or support and resistance area. Entering the market is entirely up to your approach, and you should test what suits your trading style best. Alright traders, this is it for this video. I hope you have enjoyed this video, and if you are struggling in something or are just interested in something, just let your comment down below. Please don't forget to subscribe our YouTube channel, and I wish you steady study and see you next time.